Hey everyone, it's Michael Beresford here from OpenCorp with our latest Property Wealth WOD. What I'm going to go through today is the lending landscape. I lose track of how many times we get phone calls and questions around what the lending landscape is looking like, what it means for us as either home buyers or investors, and generally in our day-to-day business of being able to help our clients navigate that crazy world of finance out there. It's often one of the things that we hear from potential investors and investors just starting out, that the finance world is daunting. Yes, it is, and it's ever changing. So it's really hard to keep abreast of all the different things that are happening. So two-part series today. First one is going to be around, I guess, what the landscape looks like and an introduction to the considerations that we've got when it comes to getting finance. And then check out part two. That's going to be around more of the specifics around the loan types, the structures, the cash flows, etc., and what that means as for us as investors who are holding investment property or significant portfolios of investment property. So the two things we're going to cover today, number one is around the APRA latest. Okay, so for those of you that aren't aware, APRA are the banking police. Basically, they put the guidelines in place that the banks need to follow. And there are two key metrics that they're holding the banks accountable towards or accountable for at the moment. The first, okay, is that they want a 30% maximum cap of interest-only loans. Okay, so typically investors are the ones that have the interest-only loans. Different banks obviously have a different percentage of their loan book being investment loans or interest-only loans, I should say, but 30% is the benchmark that the banks have to get to. So what we've seen is a dramatic increase, sometimes 60, 70, 80 basis points even, increase in recent months in the interest rates for interest-only loans, whereas the interest rates for principal and interest loans, to encourage people to shift away from interest only and onto principal and interest, have remained, fairly consistent. Okay. The second metric that APRA are imposing is on an annual basis limiting the growth to 10% of interest-only loans year on year. Okay. Now, why this one is a particularly tricky one is because it's responsible for all of, I guess, the fluctuations that a different bank will implement. So if we think about how banks work, they have an appetite at a certain point in time for a certain type of lending. They put a promotion out there, generate a whole lot of business through refinances and new businesses from that. But that creates a spike in a particular type of lending. So let's say that 12 months ago or 10 months ago, NAB, for example, really wanted to attract some investors as part of their loan book. They put a promotion out there. The number of, or the percentage of their loan book that is interest-only loans increases at that point in time. Then they're going to have more of their loan book growing at a rapid point in time there, which means that if that was September last year, in the next 3 to 4 weeks, then they're going to see or going to need to make an adjustment on what they're offering and how they keep that balance of their loan book within 10%. So quite difficult to explain, but the bottom line being is that different banks will have different policies to try and attract different types of loans at various points in time. So if it's getting confusing trying to stay on top of all of these changes, that's just a bit of an explanation as to why. The upside though for us is that there are different banks that we can go to at different points in time. So as I've talked about before, it's about being persistent and it's about exploring all of your options as opposed to having undying loyalty to one particular bank. Okay, so we just need to be a little bit more flexible in terms of what we're looking at. The second thing to go through is loan types. So as I mentioned before, there are two main loan types. There's interest only, where we're just paying a monthly interest cost, and then we've actually got principal and interest, where over time we're actually paying down the principal as well. Okay. Now, if you've read some of our material here at OpenCorp or seen some of the other WODs that we've done, you'll know that we are advocates for the interest-only structure. And it's important to understand why that is. Why that is not necessarily because it's interest only, but because historically this is the cheapest way to be able to hold a property. So if you're paying less interest or less holding cost, but you're getting the same amount of rent and the same amount of tax benefits, then this is the way that you can keep your holding cost as low as possible. What that does is it allows you to put surplus cash flow into your mortgage, or it allows you to be able to use that cash flow to hold a bigger portfolio of investment property. With principal and interest, however, what we've seen with this shifting to P&I is that the interest rates for interest only have gone up significantly, whereas the interest rates now, relative to the interest rates over here, are much lower for P&I. So let me preface this by saying this is general guidance, guys. I'm not saying run out there and refinance to a principal and interest loan. That's not what I'm saying. What I am saying though is that because of the difference between the interest rates here and here, it may well be worth reviewing your situation to see what the holding cost would be on the portfolio if some or all of the loans that you have were converted to principal and interest. Okay, now everyone's going to have different circumstances. It won't work for everyone, but it makes no sense to have your investments as P&I if the interest rates are the same. Where the interest rates are so much lower for P&I and so much higher for interest only means that it's worth actually looking at. And the second part of that is also looking at whether you retain a variable or a fixed interest rate. Again, purely dependent on what's going to work for your circumstances, but if holding cost is important and you feel that the interest rates for interest-only loans are only going to continue to increase, it may make sense to fix a portion, okay, for a certain period of time on a low rate to give you some stability on what the repayments are going to be. So there's part one of the lending landscape. What's happening with APRA, what's happening with the loan types. Hopefully you found that useful. Check out part two for what it means with some specific examples around structuring and cash flow. See you next time.